Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor.
Let's go.
All right. Well, welcome to another episode of Future Money, where we talk about the technologies of the future.
And we try to make you money.
I like that this has evolved now into, and we'll try to make you money. It used to be that makes us money.
It's tough times, man.
It's tough times. So with that said, we're gonna address the elephant in the room here. Hatem's got his helmet on.
Yeah.
Tell us, Hatem, what's the helmet?
I haven't made money in literally 6 weeks, consecutive 6 weeks of decline in markets.
Yeah.
Actually 7 weeks almost.
7 weeks. Yeah.
Yeah. And that is tough. It is tough. So I'm wearing my helmet around the office.
If you hear any of the laughing is just, it's more like morbid laughter.
Yeah.
But Hatem's got his helmet on. He's ready.
I'm ready. I'm buckling up.
Yeah.
It's part of the journey, right?
Yeah.
Like Ayal and I talked about this the other day. We're basically pilots, and we're going through turbulence right now, and it sucks. The turbulence really sucks. We're gonna make it. We're gonna make it to our destiny, and we're gonna make it safe. It's just right now we have to buckle up and stay on the ride.
Stay on the course. So we're gonna start this conversation off by the big R word.
Yeah,
everybody is afraid.
I'm gonna take off my helmet.
Take off your helmet.
It's hot in here.
We're okay. We want to be clear. Like, we don't believe in the R word. We're talking about recession here, guys, and the only way to face your fears is to actually face it.
Yep.
To get over it. So we're going to talk about recessions, what that actually means, what markets look like in a recession.
Yep.
Are we in one? Do we think we're going to be in one?
Yep.
And what happens during these times, and where we can actually hide and where we can actually take advantage.
Yeah, I think it's important to understand what recessions are. You kind of, the sentiment is so negative right now, and everyone is really talking about all the negative things that will happen basically because of prices going up and inflation and so forth. So let's start there. Let's talk about what's going on today.
Yeah. So let's define inflation. Let's define recession, because everybody loves to say the word recession, and many people don't actually know what it means.
Yep.
So what is it?
It's basically 2 quarters of decline in GDP. So in other words, the economy slows down for 2 consecutive quarters.
To negative growth, right?
To negative growth.
Right.
Exactly.
So, which is kind of an oxymoron, but you get it. We're contracting.
Yep.
And it's part of a normal business cycle if it happens.
Now, the Fed is raising rates.
Yep.
Right. So the Fed is actually trying to slow things down by raising rates.
Yeah.
And they are trying to do something called a soft landing. They're trying to basically raise rates, so they slow down the economy so we control inflation, but without causing recession. And the whole dynamics, right? Can they do this? Can they soft land this thing or not? Or are we into recession? And obviously, the markets are saying, no, they can't do it. And to be frank, their track record is not that good.
Yeah.
So
the old saying goes, bull markets don't die of old age. They get slaughtered by the Fed.
Yep.
So Jay Powell and his cronies got a big task ahead of them.
Yep.
And hopefully, Powell has proved himself to be, an adept leader of the Fed. He kind of early on, for a quick history lesson, early on when he came on the scene, was nominated by Trump in 2018. Got a little too hawkish in 2018 and raising rates.
Yep.
And we all kind of lamented this. This was the bear market in 2018 that happened.
Right.
At the end of the year, bottomed in Christmas Eve of 2018, excuse me. And to Powell's credit, he took some insight from Janet Yellen and Bernanke and reversed course on the aggressive stance and kind of mea culpa and said, all right, well, let's back off a little bit. So we're hoping, because he does seem that, inflation is a big deal. We need to get it under control. But we're hoping that they don't go too far too fast.
So going back to what recessions are, right? So normal part of the economic cycle. You got expansion, you got the peak, and then recession happens, right? What usually gets you there is a lot of imbalances, excesses they built within the economy. And what a recession does, it really kind of flushes it out, right? So you think of it as a time where all these excesses will be taken out. During an expansion, maybe some businesses that should not have been financed or should not have been alive.
Maybe some coins, maybe some crypto coins that
I don't know what you're talking about, Ayal.
Well, rhymes with Schmoge coin, or something like that.
Yeah, a lot of the froth, and again, that's good for a healthy economy. Someone says it's an economic enema. That's what a recession is really the ability, and I forgot who said that.
I would love some more clarity. I want you to continue this analogy. It is an economic enema because
it cleans your pipes, like the system
it flushes the crap out. Is that basically?
That's pretty much what I'm saying.
Oh man.
Okay, so that's what a recession is.
All right, that's the and it cleans. So obviously, when you say the word excesses, I think that it's very clear in retrospect. I mean, even at the time, we kind of knew it, right? You had the meme stocks, the GameStop and AMC. You had Dogecoin and, crypto and all these random coins. And that just sort of, everybody on TikTok and Twitter and Facebook thinking that they're, basically stock traders. That the stock market is an ATM that you can simply pull money from every day.
They all stopped working.
They all stopped working. The ATM stopped giving free money out. And so bear markets and recession tend to go hand in hand. The stock market tends to go first, right?
Stock market is always a leading indicator, right? There is a very good correlation between the economic cycle and the stock market. But the stock market is always about 6 to 12 months ahead of what the cycle is.
It tries to guess what's going to happen.
Correct, and that's why it's a leading indicator, right? So we've seen last year the IPOs, the SPACs just getting crushed, right?
For sure,
minus 80, minus 90, right? And then this year, we're starting to see that seep into just a traditional stock market, the NASDAQ first, and then the S&P and so forth, right? And then now we're going to start seeing that in the economy, right? Spending is going to go down. We're starting to see companies not hire. Right now, it's just hey, we're not going to hire anymore.
We're freezing. We're slowing things down.
But then you're going to start hearing about companies firing people. Right. So the sentiment is going to seep through the economy and is going to start making executives and corporate CEOs and investors make things or do things. And those things are going to slow down the economy.
But we want to make it clear. A slowdown does not mean recession specifically. So at GK, we're not particular in the recession camp, right? We're not really, we believe that a recession won't happen, but we don't know.
I don't think anybody knows when it happens, first of all, right? So it'd be foolish for me to say I know. It's very hard in general to know when you are in recession, and you only know once you're in it.
Because
you're in it.
You said leading indicator for the stock market. The recession is a lagging indicator because by its very nature, it looks back 2 quarters to see if you were negative.
But I think, and this is a conversation I'm having with clients right now, is you need to differentiate between financial crises, which is what we had in 2008, where we thought the financial system was going to collapse, literally, with just a traditional recession, which we've had, I think, about 10 recessions since the 1950s. They don't happen a lot, but they do happen. And every time it was caused by a different thing. And we got through them.
And it always feels, and I just had this conversation with a client today, it always feels, quote, different, or it always feels like something is different this time. And it, while one of the things might be different, the ultimate framework is the same. Right? Like you said, excesses, euphoria, like this is the business cycle, things come down. Now you can have a deep recession like your financial crisis, like you said, where we were worried that everything was going to collapse and our system was going to die as we knew it. And otherwise, like none of that is the case right now. Banks are very well leveraged. Everything is actually okay. So go ahead.
So the one thing we want to add too is even though each one is different, as you said, there's similar things that happen during recessions, right?
Exactly.
People start losing their jobs.
Correct.
Commodity prices go up.
Yeah.
Inflation usually goes up, right? And then it goes down.
Yeah. Yeah. And so whether we're in a recession or not, a lot of that stuff is kind of happening already. But what we don't have is unemployment. Actually, we have the tightest labor market ever. Companies there's still two job openings for every one person to take that job.
That's insane. I heard that number too, and it's just so you can't really go into a deep recession when the job market is that tight.
Correct. Yeah. And to be clear, technically, if you had a negative 0.1 GDP and a negative 0.1 GDP, that's technically a recession.
That's exactly it. Yeah.
So it could be deep, it could be shallow, if it even happens at all. You could be like Australia, where I think up until COVID, they didn't have a recession for like 30 years.
Yeah.
But if you have slow growth, and even in the US, like people complained about the slow growth for a decade. We didn't have a recession until COVID hit. And obviously, I think it's important to understand that COVID created some very weird scenarios in our supply chains, in our markets, inflationary measures. It sort of really kind of threw everything for a loop, because we had to artificially prop everything up, and now we have to artificially take everything away.
Right.
Supply chains are still weird.
I mean, we never had to shut down our whole economy.
No, the whole world had to shut down their economy. Like, think about shutting down like a street, let alone the entire world's economy, and then restarting it from zero.
Yeah. And also China had to shut down again, which is, so these imbalances are just unprecedented. And I don't think any economist or any person really can understand the secondary, tertiary, all the ramifications that you get for something like that.
Right. And I think it's important, right? We talk about inflation. Inflation's really high.
Yeah.
I believe that, if you look at our inflationary numbers, a lot of it is supply chain constraints.
Right.
And kind of the stuff that we did, the emergency services that we had to provide during the COVID lockdowns, is much more reminiscent of the 1940s and 50s post World War II.
Right.
We built up a ton of debt to finance a war.
Yeah.
Right. We had to issue war bonds and trillions of dollars in equivalents today.
Mm-hmm.
And then once the war was done, and the factories were all producing machinery and weapons for the war, now we have to reapply that back to the economy. So everything kind of gets messed up for a year or two or three until this all comes back. So that's what I believe. Our economy is much more like it was in the late 40s than it was in the 70s and 80s with stagflation.
I totally agree with you. I think it's like a readjustment, a rebalancing that needs to happen after such a almost a disarray.
What was basically the Thanos snap of the world's economy in 2020.
Ayal is obviously a big...
Come on, everybody knows the Thanos snap. Even you do. You don't watch them. But
I don't watch them, but
you get it.
Okay, so it's futile for us to figure out if we're not in recession. It's an opinion. Let's talk about what happens. Okay.
Yeah.
What happens in recession? What's going on right now in the economy? So there's a few things that we see. One is we have usually an inverted yield curve,
right?
Meaning that,
so the short term, right? So we hear this all the time, that the short term treasury, the government bond, and usually there's all kinds of short term ones, but really it's the 6-month treasury, right, or the 90-day treasury, inverts with the 10-year. So meaning that interest rates for 30 days is going to be higher than it is for getting for a 10-year bond. It doesn't actually make sense.
Right.
But what that is saying is that the economy, that the people don't have any faith that the economy is going to be better in a few years versus today.
Yields are a confidence game.
Yeah.
Yields are basically, normal yields show you that, if you loan me money for 30 days, you get less interest than if you loan me for 3 years or 10 years and so forth, right? When that inverts, that dynamic inverts, it just tells you that we have less confidence. That's usually a sign that there is a recession happening.
Yeah.
We had one. We had an inverted yield curve. It didn't last for a long time.
It's very quick.
Very quick.
And it's another, generally, if there is a recession, another indication that if there is, it might be a shallow one if the yield curve inverts very quickly and then reverts very quickly.
Okay, check mark. We got that.
All right.
All right, let's go. What's next?
Profits, corporate profits.
Yeah, corporate profits, big ones, right? Stock market goes up over time because companies make money. over
Right.
time, right? So what happens is, and I think that's really the biggest indicator of long-term growth is,
Yeah.
are companies making money over time?
Right.
During recession, you usually see corporate profits go down.
Go down.
Yeah.
Okay. I want to make it clear. Corporate profits are not down. They are up almost 10%. Okay.
Yeah.
Now, if we took the shock of the COVID economy away, if we took the weird, crazy numbers we got from tech companies in 2021, because they had 40% growth for $1 trillion companies, 10% in any year is a good number.
That's awesome. That's a really good number.
Yeah. And now they're like freaking out. They're like, oh, well, they lowered their guidance and they'll only be up 12% next quarter versus 15.
If anything, I think going into the last earnings quarter, you know, despite inflation, despite supply chain constraints, you know, companies were able to really navigate this and keep margins and profit. So I think the resilience of corporate America is really impressive.
Absolutely. And I think this is the big one, because over time, like you said, the stock market goes up.
Yep.
Not because you like a stock, not because they're, you know, some fancy thing that nobody's ever heard of, because the profits are going up. That's what the market cares about over time.
Yep. Okay. We got that. And check.
That's an X, right? So if we're doing check versus X, so we're
unemployment. Usually during recession, unemployment spikes.
Yeah, I don't think, at least not in the near term, I don't see that. Now, once again, if there's a hiring freeze, there's 2 openings for every person. So maybe there'll be 1 opening for every person.
I think it's going to take some time to get that slack through. You're right.
Yeah.
You're absolutely. And like as soon as people are qualified, you know, I think the other dynamic that we don't really think about is that because of COVID, we can work from anywhere.
Right.
So actually companies can hire from anywhere.
Right.
The barrier to entry is basically a Zoom call. You know what I mean?
For sure. For sure. So if the economy slows its employment and we have 1 job opening for every 1 person looking, that's actually not a bad thing.
Yeah.
You know why? Because that means that companies are not forced to pay 20-30% above what people are asking right now. Is like, this is one of the issues that is happening with inflation, is everybody's coming in demanding obscene numbers for their investments because inflation's higher. So it's this cycle. But if we get a reduction in how many job openings there are, that's not necessarily bad if I can go to 2 companies for every job versus 1.
That's okay. And check.
X.
Yeah.
What else?
Housing starts. During recessions, usually housing starts go down about 10% on average from the previous year.
Yeah. Well, we had no housing starts. And actually we're going up in housing starts.
Yeah.
So how much does that change? I don't know.
The housing market is tight, man.
It's
like
tight.
I think every house gets built is going to be sold.
Yeah.
And I, you know, even rates going up, we're still seeing a lot of demand
because there's no houses.
There is no houses. There is more formations. The poor millennials, you know, they have families. They want to live.
Poor as in sad, not poor as in dollars.
No, they actually the millennials have done very well financially over the last few years.
I just wanted to make it clear that
but they want to move out of their parents' houses.
That's by the way, you know, depending on who you ask, I could be a millennial. I just turned 40, by the way.
The millennials,
I do not live with my parents. I want to make that part clear.
That's true. That is true. I actually vouch for that. Okay, so that's also
housing starts. It doesn't seem at this point. So once again, this can all change if things get worse. But it doesn't seem that housing starts are going down. It actually seems like they're doing more housing starts. And actually, now that some of the inflationary forces are actually being normalized, lumber, materials costs, it's actually better for home builders now. It's easier to build houses than it was literally just like 3 or 6 months ago.
Yeah. And that's something that a lot of home builders, developers are looking at, right? Like they're not going to make as much money for sure because their margins are getting squeezed because of inflation and labor and so forth. But demand is going to be there, and how much demand is going to be there is going to determine if this is truly becomes a tough time, a tough economic period or not. Yeah. Right.
And we might see real estate slack happen a little bit because prices were high, rates were low. Rates are now coming up again, like have come up. So we might see a slowdown in housing, but that supply of real estate.
Listen, I talked to some really smart and successful real estate people, and even them, they say in LA, for example, these properties are going up 10-15% a month in value.
Yeah, that's
just
not supposed to happen.
That is not sustainable.
Right.
You know, and even them, they're like, yeah, I'd like to sell more expensive homes, but you can't keep doing this for a long time. So I think that equilibrium needs to be reached, and it's nice for prices to come down a little bit. You know?
For sure. Agreed.
And lastly is the leading economic indicators. So that's your stock market, right?
Mm-hmm. So we had that 20%.
Yeah, 20%. So the market is telling you, and the market is basically pricing in a severe recession.
Well, we had the S&P go down 20%. It hit it. The news will say, oh, we didn't technically hit it intraday, interday, whatever. Yeah, we hit it. What the top number and the bottom number were 20%. And so we got there, and then the market kind of bounced around it a couple of times, and we've sort of gone up a little bit. We've come back down, gone up. Yeah. So the stock market is priced. The NASDAQ is down 30%. So the market, the NASDAQ has more technology stocks, more higher valuations, so it'll get hit harder during these downturns.
The NASDAQ, I think, is more a factor of interest rates and valuations, right?
Valuations coming in, which is part of this whole process.
That's exactly it. It's just revaluation of things because rates are higher and future cash flows and so forth.
And I get this question too: is people will say, well, from 2000. The stock market, the NASDAQ topped out and then didn't make a new high for you guys to know, it was 16 years that the NASDAQ didn't break out to a new high. And are we in for the same kind of thing? Right. Yeah. But I always tell everybody, at the height of the market in 2000, the NASDAQ price to earnings ratio, the PE ratio that we love to look at, was 100. Okay. Today it is under 20.
Man,
okay.
Think about that. 5 times more expensive.
5 times. So basically, if the NASDAQs are roughly 12,000, it would have to be at 60,000 right now for us to have the same lofty valuations. Now, what we did see was
the SPACs.
What I call the mini .com bubble.
Yeah.
The SPACs, the IPOs over the last couple of years.
Yeah.
That went public at insane valuations.
Yeah.
It used to be.
Frankly, a company should not have been gone public.
100%. But it used to be like when Netflix was a high value stock. I remember when we first bought it in 2013.
Yeah, we
had a debate about it, and it was a 10 prices to sales or price to revenue multiple. So if a company's not profitable yet and they're in a growth mode, so we use a price to sales number.
Yep.
10x, and we debated and we said, man, this is crazy. 10 times revenue seems really high.
Yeah.
And we ended up biting the bullet and doing it because we thought it was a high growth company at the time. We were seeing companies that were pre-revenue. Somebody was talking to me about companies that literally not even that they didn't make earnings, that they didn't have $1 of revenue going public. Virgin Galactic.
I was going to say,
dude, these
QuantumScape.
QuantumScape. These biotech companies that were DNA, mRNA. You just had buzzwords. Like people it was like price to buzzwords was the
price
new
to buzzword.
Like that was the new thing. And so those stocks have gotten obliterated.
Did you just come up with that?
I just came up with that literally right now. Yeah. So if anybody else uses that,
price to buzzword,
I demand a royalty from there.
Yeah.
But so this stuff, whether it's 50, 60, 70 times revenue stocks. And I remember having conversations with clients of mine because you and I both work with a lot of tech startup people.
Yep.
Saying, listen, you got to sell a large chunk of this stock because I don't care how good the company is. If the stock got chopped in half, and I literally had this conversation with it, if the stock got chopped in half, it would still be an expensive stock.
Yep.
Lo and behold, some of these companies are down 70, 80, 90%.
Yeah, I can't emphasize what Ayal just said enough. We've done this so many times now where, you are working with, you have built this wealth in a company that is, trading at these crazy multiples. You got to take some money off the table.
Yeah, for sure.
You got to,
Don't let FOMO and even taxes make you make bad decisions.
You got to.
If you made $5 million on a stock, it's okay to take some money off and go, well, what if it was 10 million? What if it was 11 million?
Yeah.
right?
Because it could go back to
1 million
Yeah.
or zero
Yeah.
at some point. So it's very important to keep that stuff in mind.
Okay. So now, what happened in the last 10 or 12 recession that we've seen since World War II? I think this is the meat,
Yeah.
guys. This is the work. We actually prepared for this podcast.
Yeah, exactly. So what's the average drawdown in the markets during that time? It's about 24%.
Wow. Okay. 24% during recession is how much you see the market drop down. Where are we right now?
We just said we were at 20.
20 on the
Right.
S&P, 30 on the NASDAQ,
Right.
give or take.
Right.
Right.
So that sounds about right.
Yeah.
Right. So we made most of the way there. Right.
Also, the average, I think, really important that we did a lot of research on this.
Yeah.
The average recession lasts between 11 and it's about 11
months.
Yeah. But usually it lasts between.
Well, the average bear market. Right. And recession.
No, this is recession.
Oh, the recession? Okay.
The actual recession.
Okay.
About 11 months, right?
Yeah.
And it's an average, but usually it's between 9 and 18 months.
Yeah.
So between a year and a year and a half, basically, right?
Right.
One can argue that we've been in this bear market for about 7-8 months now,
Mhm.
right? And if we are in recession already, maybe 3 months or 6 months.
Yeah.
So
Yeah. I mean, so the average recession is about that long, and the average bear market is about that long. So the average bear market's about 11 months, and the average expansion is about 4.5 years.
Right. Exactly.
Okay. So for those of you who are not great at math, 11 months is a little bit compared to 4.5 years.
Yeah. And we don't want to minimize the fact that 11 months is a long time.
It's a long time. It hurts when you're in it. It hurts really bad.
Especially if you lost your job or, you're worried
Absolutely.
about, so there's a lot of, non-monetary things that happen with recession and so forth.
If
so
that happens, right. Exactly.
Yeah,
right now, none of that has happened yet.
Yeah.
Everybody, we have the tightest labor market in history right now.
Right.
So,
and by the way, that's why we don't think we are in a recession
Right.
or we're going into one, at least not in the short term.
right. And once again, like we say, we don't think doesn't mean we don't know.
Right.
Right. So we have that, right? So the average drop is 24%, we said, right?
Yeah. What's the average drop on earnings? Because we talk about also earnings dropping.
Yeah, the average drop on earnings is, what is it like? I can't remember the number off the top of my head, Hatem.
I think it's about 13%.
13%. Oh, right. 13%. And then a 17% snapback the following year.
Yeah.
Right?
Yeah.
So once again, that means that you basically made back almost all your money a year after that.
Yeah.
Okay? And earnings in the market.
Yeah.
Corporate America is some of the most resilient, numbers you'll ever find over time. They just, it's like clockwork almost.
Yeah, we do have some of the best companies in the world.
Yeah.
And that's the reality. We have some of the best balance sheets in the world, right?
Yeah.
Like if you think about how healthy some of especially the companies that we invest in, right?
Yeah.
And we're talking these companies have billions and billions of dollars just in cash.
Yeah.
Just to be able to just sustain themselves, right?
Absolutely.
So the reality is, yes, what's happening right now with inflation, with supply chain, maybe will reduce or hurt earnings going forward. But right now, we just don't see that.
Right. So the economy, once again, can be slowing. It doesn't mean it has to go into recession.
Right.
And slowing is not necessarily a bad thing to get inflation under control.
Right. Yeah. And again, this is the little landing, right? Soft landing.
Right.
Can we slow this plane a little bit, but we don't really crush it?
Right. Not crashing it in.
Yeah.
Right. So also valuations, right? So on average, the S&P contracts about 20%, right? The valuation.
Okay.
Right. So what that means is we just talked about this, the PE ratio, price to earnings, how much stock's price is versus how much earnings they have as a company, goes about 20%, right?
Yeah.
So what that means is basically it's a contraction of valuation.
Right.
If people are less bullish on the economy,
we want to pay less.
They're going to pay less
earnings
for it, right? So right now, our forward PE, meaning the expectations for earnings in the future, and our trailing PE, are both below the 5-year average.
Wow.
Okay.
So if you think about that, right? So we've already done so much contraction within the economy, or the S&P and corporate America, to contract over 20%.
Right. And it's even below. So the forward PE is still below the 10-year average as well.
Yeah.
So the market is saying, okay, the market is slow, the economy is slowing down. Maybe there's a recession, maybe not. But ultimately, this has already the PE contractions, the valuations have already come in to the point. Okay.
Yeah.
So right now we're looking at good valuations.
So
right
what are you saying? I can't stop but to think of what Warren Buffett said, right? Yeah. Price is what you pay, value is what you get, right?
Yeah.
And what that means is that it's a great saying, right? It really what that means is you pay for something is what's the value of that something. If I'm paying 16 times PE for the S&P today, I'm underpaying because the average PE is 18, 19 over the long term.
Right. So now we can argue all day long about should the multiple be 16, should the multiple be 15, should the multiple be 18?
Right.
Higher rates means you probably get slightly lower valuations.
100%.
Right?
Yeah.
So when rates were at 0, the market was fine being at a 20 plus PE ratio. So at the peak, just so everybody knows, at the end of last year, the S&P's PE was 24.
Yeah, 24.
Okay. Yeah. So we were well ahead.
That was before, yeah. Not now that we got through that period.
Yeah, exactly.
That's when the Virgin Galactic.
Right, exactly. So the
upstart.
The P has come down.
Yeah.
Right. The price has come down, and the earnings have still managed to go up.
Yeah.
So that's how you're getting more relative value when you buy today. Regardless, we don't know if we're in a recession. We don't know if we're heading to one, or if this is the bottom or not.
Right.
But when P comes down and E goes up, and the PE overall comes down, that's a good sign.
Right.
Okay. Because right now, basically, we're trading at the lower end of the PE range that we've had.
Right.
The last time the PE was this rate was in December of 2018. Well, guess what? Yeah. That was the bottom of the bear market in 2018.
Yep. And then we had a nice little expansion, and then we had a pandemic.
And once again, the COVID pandemic, right? We had a recession. It was very quick. We had a bear market. It was very quick. So it sort of like defied all the normal recessionary bear market things because it happened in a flash.
100%.
Right.
Yep.
And the Fed stepped in and provided all this liquidity and all this stuff. But basically, we're back to the valuations of 2018, the valuations of 2014.
Yeah.
And from what most people don't know is in 2015, we didn't have an actual recession, but we did have an earnings recession.
Well, okay, well, let's explain that.
Yeah.
Because what is that?
So the S&P 500, which represents the 500 big companies in America, had earnings go down for multiple consecutive quarters in a row. So while the GDP of the US didn't go down, the earnings of these companies did go down. So the stock market is actually based on earnings.
Yeah.
Right.
These were the Obama years when people were complaining about the economy not going fast.
Correct.
Yeah.
And for people who don't remember this, because most people don't, because I promise you in 3 years, 4 years, when we're out of this, you probably won't remember this bear market
it in 6
either.
months, dude. What are you talking about?
Our clients probably won't remember. But in 14 to 16, basically the stock market did 0 rate of return.
Correct.
We had it. We went up. We went down. We got to an 18 or 19% on the S&P.
Yeah.
And then it came back, and we sort of bounced around until we had some more expansion in 2016.
Yeah. So I think what we're saying here is not. It doesn't just go up, right?
Yeah.
These things can happen all the time. Earnings will go down, stock market go down, then goes up, then we go sideways.
Yeah.
So this is kind of a normal part of how things work, and nobody knows when that's going to happen. And this is really what's important is, people say, well, you should have maybe sold when PE was this much or when this happened or whatever. The reality is just nobody knows.
Correct. And by the way, the PE was elevated for 2 years because of COVID, once again, because earnings were still coming in really good. So if we were to follow the PE number, we should have sold 2 years ago, actually.
Right. And then you missed a 40% move.
Right. So it's always easy in retrospect, to say this or that or the other. We should have bought energy, because we knew that was going to happen.
Right. So okay, so let's talk about that. Like, what sectors kind of do well during either recessionary periods or periods of slowdown? Right?
Yeah, we call these the defensive sectors.
Yeah.
Right. So in general, you got energy, you got utilities, consumer staples. That's your Procter and Gamble. Boring stuff. Exactly.
Boring stuff.
Healthcare companies.
Yeah.
So these are the things that generally do well, right? It makes a lot of sense.
Yeah.
If you're hunkering down, Where are you cutting? You're cutting discretionary spending, right?
Exactly. You're not going and buying a Tesla. You're
Right.
not going and to fancy vacations, but you
Right.
need to buy oil. You need to buy
Right.
consumer staples, which is your Campbell soup and
Right.
whatever that
People
is.
need soup.
Yeah,
People
yeah.
need soup.
I think that's a little bit too simplistic
Yeah.
in many ways to just say Campbell soup, but it is true. It's
the
a
idea.
trend.
Well, it's like, I think like Procter and Gamble is a great example,
Right.
or like Kimberly Clark, right?
You
toilet
need
paper.
toilet
You need
paper.
toilet paper. It doesn't matter what's happening in the world. You need toilet paper.
Yeah. So that's actually happened right now. Like,
Yeah.
I think I want to spend some time talking about this. Oil prices have basically gone up through the roof this
Yeah.
year, and the whole energy market or the energy sector is up almost 50% this year, right?
Yep.
So Gerber Kawasaki does not believe in investing in fossil fuels going forward, because we think over the long term, when we always think 5 to 10 years out, structurally, that is an investment that is declining.
Correct.
Right?
Right. And if you look over the last 10 years, it's actually the worst performing sector in the S&P, including this giant move.
Right.
And, it takes a seminal moment in history.
Love that word.
Yeah. to change how people look at things, to change people. What's going to get people to act on climate change? What's going to get people to act on moving to EVs and things like that? Tesla can make beautiful cars and a certain people will adopt it, etc. But ultimately, and I say this all the time to people vote with their wallets, whether it's with politics or what products they buy, etc.
Yeah.
So
I think what you're trying to say is this is a seminal moment for renewable energy.
Absolutely.
Right? For solar.
This is that moment where we realize the world is being held hostage by dictators, by governments that we don't want to associate with, while they're burning up the earth at the same time.
Yeah. The biggest winners from oil prices spiking, besides some of the oil companies, is really Saudi Arabia and Russia.
Venezuela. And Russia's holding the world hostage because of this.
Some of the worst regimes in the world, who are committing atrocities that just unfathomable,
that are funded by fossil fuels.
So hopefully, I think what happens here is we really, and I know Europe is doing it out of necessity.
Right.
Europe is actually spending 200 billion euros just this year to shift to renewables.
Yeah.
Right.
Yeah. And obviously being in California has always been a leader in solar and renewables, and not just solar, wind power, geothermal, all that stuff, nuclear, hopefully.
We say that in California, but some of these policies around the state are
listen, everything is relative, right? If you compare us to the rest of the, like who does it better than California does? You know what I mean?
That's true.
My hope is this is that seminal moment in history where we can look back and say, okay, Russia basically threatened the world with World War, threatened Europe, because they have access to basically one commodity that everybody needs. That, by the way, is harmful to everyone on Earth. I don't care what your political affiliation is. This is science. This is not politics. So this is that seminal moment, hopefully, and renewable energy is where we want to be investing our money in, not for the next 6 months, but for the next 5 years.
So listen, we were bullish on this stuff. I don't think we've ever been more bullish on this stuff. This is our silver lining, I think. Hopefully we learn from this and we progress is not straight line. Progress comes in
absolutely.
So hopefully this is what happens from this.
I love the progress is not a straight line. It's something I say to some people all the time. It's not a straight line, and I want to the next few months could be tricky for renewables. They're high value companies and all this kind of stuff. But again, over the long run, this is something that is going to change the world for the better.
Right.
So let's lean into that.
Yeah. So that's for sure. So a couple of things. One is obviously I had my helmet on because the market has been rough, right?
Yeah.
As in 6 months, we're basically down 25% on average between indexes. And I get a lot of questions. Hey, why don't you just get out and then move back in? Like, that's a question that I get quite a bit,
Yeah.
And the reality is we don't, because if you don't know when you're going to have a day like today, which is
Right.
the market is up 3% because China is reopening.
Right.
Like, you don't know what small events will happen that will create a rebound, right?
Right.
But ultimately, if you look at the declines over the last, 50 years or 100 years, right? The biggest declines were in 1929.
Right. That was pretty bad.
Pretty bad, almost 90%.
Yeah. That was when they barely knew what a stock market was.
Right.
And it was
very, very different.
Yeah. Yeah.
Yeah. But that following year, the market rebounded about 137%.
So it's important to note this, guys, is everyone always asks us to try to sort of read the tea leaves about markets. And I joke with my clients all the time. I say, if I could do that, the only person's money I'd be managing is my own. I'd be that rich.
Yeah.
So we can't do that. And since the returns of the market happen on a few days really out of the year, that what you were talking about, we can't predict the downturns, but we can't be out on the days where the market makes their rallies.
Right.
So we just have to stay the course in an investment position that we're comfortable with for the multi-year process.
Right. And also you can change allocations. You can maybe get more aggressive or more conservative depending on where things are.
Right.
Absolutely. That's what you should be doing. But you just can't think that you'd be able to, even if you can pick a time to get out and you call it and you get lucky, I guarantee you you're not gonna find the time to get back in.
Right. And if you did it once in your life.
That's exactly it.
So there's certain hedge fund managers that I'm thinking of right now that like to short things.
Yeah.
They like the big short things.
Yeah. Big short things. Okay. So again, the good news is recessions don't last too long.
Right.
Okay. The market is always a leading indicator. And the market right now is pricing in the worst, right? Assuming that the worst doesn't happen, I think we're in for
a good rebound.
For good rebound.
Yeah.
And I think that's what I'm seeing. Now, Ayal and I talk to a lot of startups, talk to a lot of founders, a lot of people in the tech industry. And I wanted to also give some advice there because I'm talking to founders, I'm talking to what's going on. So what do you do in this environment?
Listen, you got to figure that. So obviously private valuations are now just starting to get cut.
Yeah.
Because once again, they're illiquid, so they don't move as fast as the stock market.
Yep.
So just make sure that you're in a strong financial position, that you're not burning cash it's going out of style.
Yeah. Trim the fat. Right.
Don't expect 100 times revenue multiples.
Yeah. Don't expect it's going to be easy to raise money.
Right. Exactly.
Because what you did before is not gonna be as easy. You're not gonna have a bunch of VCs coming at you with cash. Right.
The game for the last decade has been raise money, burn, raise, burn, rinse, repeat.
Growth at any cost.
That time is coming to a close. It's not coming to an end, but it's definitely coming back to reality.
Yep.
And if you look at this, and I kind of did this exercise actually with Ross and a couple other people, and I said, think of a company that went public over the last 3 years.
Yeah.
That was a tech or a growth company, not like, some random company that was a spin-off or something.
Right.
Have they been profitable? Have they been able to have a positive rate of return over the last 3 to 5 years even at this point? And I couldn't think of one, honestly.
I mean, there's a very, very few. There's definitely very few that, I can't think of any.
So focus on quality, focus on trying to at least become profitable or have a path to profitability.
Yeah. And also the other thing, and I really like this because I read it somewhere. Some of the best companies in history have been created during recessions.
Yeah.
From the Ford companies in the 30s to Airbnb in 2008 to Salesforce in 2000
to Bitcoin in the financial crisis,
Google,
right? Google after
to Bitcoin, right?
Yeah.
So the founders, the companies are able to really navigate this tough environment. They have a compelling product.
Correct.
They have something that people want at a good price.
Yeah.
Will thrive and will build some amazing.
The cream of the crop will rise to the top.
Yeah.
And the companies that had no business being there, the frothiness is going to be gone for a while.
Yeah. And this is why capitalism is amazing, right?
Yeah.
So buckle up. Right?
Yeah, buckle up. But once again, we're cautiously optimistic.
Right.
Okay. We don't believe, once again, we don't believe we're going into a recession. And when you own quality companies, so in advice for investors, ditch the speculation. We've been saying it for a while now. Ditch the speculation.
Right.
Focus on quality. It's okay to have high value companies if they're profitable and they have great growth rates and they have great management and you know what you're investing in and buying in. Like people got up last week and sold Apple like it's nobody's business. Like why on earth? We had clients ask advisors why we own Apple and Google.
Yeah.
That to me is a sign that we're nearing a bottom at least. Like if you don't know why we own Apple, Google, and Microsoft, honestly, I don't know what to say. These are some of the best companies that have ever existed.
Right.
And so if you focus on these companies, remember what you own. Remember if you're in a diversified portfolio, right? If you're margined up buying, Tesla with 300%.
And that's the other thing.
Worth,
avoid margin. Like
avoid margin.
Avoid
That's
leverage.
how you blow up your financial plan.
Right. Exactly.
Right. And yes, you could win big.
Yeah.
But if you swing for the fences every time, if to use a baseball metaphor, if you swing for the fences every time, most of the time you strike out.
Right. You get lucky sometimes, but
Yeah.
often, and this is just not a time to do it.
No.
And realize that those macros really matter.
Right. So you stick to your guns, you stick to what you're comfortable with, focus on quality. Over the next 3 years, we're pretty bullish on what's happening. We think there's a big tech revolution that's happened that came from COVID in healthcare and tech.
Yeah, I think this digital transformation story is just getting started.
Right.
This cloud story is just getting started.
Right.
This, metaverse story is just getting. Look, there is so many awesome themes.
Right.
And you just gotta be patient.
Just gotta be patient. You gotta think about the long run, and you just stop looking at your accounts on a day-to-day basis. It won't change anything.
Yeah.
Think about your goals. When you're investing money, you have to think about what are my goals with this money. If my goal is 10, 20, 30 years out, it doesn't matter what happens today, guys.
Yeah. Well, there goes the show. I think we got it all out of the way here.
Yeah. And just keep your heads up. Everything will be fine. Onwards and upwards.
Yeah. Buckle up. Focus on, summer is starting.
Yeah.
Yeah.
Focus on doing fun stuff. Travel, I'll tell you that travel is definitely not suffering. And it's just go out and have a good time. And remember that a year ago or a little over a year ago, we were locked in a house, couldn't go anywhere.
Yeah.
So
let's enjoy that. Let's get that perspective.
For sure.
Yeah. Thank you for listening in. Thank you for the feedback. Any questions? We're here.
Yep.
But buckle up. We're in for a ride, but things will get better.
Things will get better for sure.